everybody. This is Gil here and Dr. K coming at you from the beach here in Los Angeles. I'm assuming everybody can hear us pretty well. Happy Thanksgiving, everybody. Even those Europeans out there who don't celebrate, or do they? Dr. K, do they celebrate Thanksgiving in Europe?
Not really, no. But you do have a lot of people from the U.S. that are, scattered around Europe, and they may choose to. So they do have some places around that will celebrate it
I
on
see.
that basis.
Well, the market reminds me of the joke we used to have at O'Neill. The market's down 14%. That's the bad news, but the good news is it's on light volume. So, we see a light volume drift down today. The market's continuing to make lows. And that's pretty much where you're at. You have this gap down on Monday, and we're just continuing to drift lower. And it's not clear to me where you're going to find support, but this is starting to look pretty ugly to me. The model, however, is not on a sell signal. And I think the way you can compensate for that is that there are short sale target stocks that you can come after. And, we've talked about Apple and Amazon as potential short sale targets, and they have worked and probably continue to as long as the market continues to move lower. But the market direction model, being based on a different set of criteria, has remained on a neutral signal. And so, Dr. K, why is that?
Well, essentially, you've got a lot of chop and slop prior to well, we've got chop and slop really since August, and basically since earlier October till just recently, the market's been led by headline news, gapping down on bad news, while QE, meanwhile, will push the market higher. There's evidence of QE in action because the TED spread continues to climb. The widening TED spread is an indication that not all is right. There's something definitely wrong, and the TED spread tends to go higher the more nervousness there is out there. For instance, it spiked in like 2008.
Dr. K, are we seeing the TED spread widen now?
Yes, we are. It's relentlessly going higher every day, and that tells me, well, this has been true actually since October. So the market, if people will look at their Nasdaq and S&P charts, they'll see that the market ground higher. It would go down on bad news, and then it would grind higher on quantitative easing.
When was this?
A widening TED spread. This would be mid-October till mid-November, and you'll see that the market would tend to go down on bad news and then go up on QE. There was one piece of good news in there when they approved the 1.4 trillion euro QE package. Where the ECB stepped in and said, okay, we're going to do this. But outside of that, this upward drift has been a definite sign of QE. Probably stealth form in the U.S., dictated by the Federal Reserve, and potentially Bank of England, who raised their line from 200 to 275 billion, and now the ECB jumping on board, although they've been slow to print, to actually undergo toward that 1.4 trillion. But nevertheless, it's an interesting divergence because usually when you see the TED spread widen like this, the market should have started selling off in October, and it didn't. Now that creates a lot of uncertainty in this environment. In other words, you've got a tug of war between QE, which pushes the market higher, and negative news out of Europe, which obviously pushes it lower, usually in a gap down format. So it was really until 3 days ago, the 21st, that we had a concerted gap down on negative news. Prior to that, the market was very wishy-washy. So the model elected to stay in neutral during these very difficult periods because it doesn't have much of an edge when you've got this kind of tug of war going on. And on I guess it was Monday, the 21st, when it gapped down. Well, the model's not going to just all of a sudden switch to a sell signal on that day because now things are starting to look oversold. Plus, you still have QE in effect, so we could get just as easily an upward drift in the markets on Monday, Tuesday, or after today. And we also are going into a seasonally stronger period, so you got a lot of tailwinds and headwinds, cross currents in other words, that are going to make for a lot of volatility, and the market model elects to stay in cash during these periods. It's better to just keep your powder dry, wait for a bigger opportunity where you have more of a clear edge.
Okay. And what I would say, though, just objectively, if you're looking at the last 5 days or so, 5, 6 days, there is really no QE to be found anywhere in the market because it sure doesn't seem to be coming in to support the market here. You continue to drift down. You have light volume down days, and there's nobody stepping in. That doesn't mean that you can't see some money step in at some point and start to drive everything higher. But it doesn't seem to me, and it's somewhat conspicuous here, that there is any money willing to come in. We'll see whether it comes in and supports these names or the market in general. But what I'm seeing in individual names, myself as a trader, is a lot of weakness and a lot of shortable weakness. So my inclination here is to be very bearish on the market and stocks, despite where the market direction model is. And I think that's played out in individual stocks. So you can come out the market, again, not so much as a stock market, but as a market of stocks and focusing on individual ideas. Now, on the short side, I have been focusing on just a small number of stocks. And, you know, if you look at it in October, despite the fact that the market was up big, I actually made a lot of money being short pretty much one stock. You guys all know all about this. Let me see if I can get to my daily charts. And of course, that was Green Mountain. Another one that offered a lot of opportunity was Netflix. So, you know, you've got the situation where there are a few situations right here where you can get short and you can make a lot of money. And so that's kind of what I'm looking at and watching for. Now, I think you have to be patient here and wait for the proper setup. If you start to come in too early, you can get kicked around. If you come in too late, if you come in too early, you got to come back and forth. But I think the timing is critical, so you want to be on top of it. You don't really want to lose focus and get distracted. So to that end, I think you have to be paying close attention to where these rallies are going. So my new targets here, and the ones I'm focusing on, are Amazon, which we're seeing today is kind of in this little consolidation after a couple of big gap downs in the pattern. I think this looks shortable on rallies up into this area. I don't know if it's going to fill this gap. It tried to earlier go higher, tried to clear these highs, and it hasn't been able to do it. Volume, I think, right now is up on the day 35%. So there's a little bit of a tug of war going on between buyers and sellers here. And right at this level, I think it's possible to come in short and use today's high as a quick stop if you want to try and do that. Yeah, it's only about 2 or 3% max away from here. So I would be looking for this to roll lower. The one thing I'm noticing on this one is that you are seeing it try to hold this 190 level here, and you notice there are some lows right in here that formed in the early part of August and the later part of August, and so that creates a little bit of an area, I think, both of resistance and maybe support, because you notice it's fighting on either side of the line here, the 190 level, this red line that I've got on my my crosshairs. And it's hanging out. My guess is it's going to test this low. That's what it looks like. So I think that I'm trying to short a rally. I don't know if this thing pushes up to this low here, which is 197.11, so it would fill the gap. Or if that, you know, and that would become your resistance on the upside. It could get up to 200. Now, of course, I'd love to see it get up to 200, but it's pretty weak. And you had some nice volume yesterday. There's news about the Kindle coming out, but they're going to puke up $132 million on the Kindle, so it's not like it's this hot-selling product that's going to bring them in a lot of revenue. Now, I think people who buy a Kindle, are they going to bring in a lot of new customers? The argument could be that they spend that money on the Kindle in order to bring in customers in the other business lines that they have, from streaming movies to the Prime service that they have, and, of course, you know, buying things on the internet for Christmas coming up. But you know, I don't really see that necessarily as expanding their base very much. So what are they really doing here? Well, they're competing with Apple, I suppose, and they're keeping themselves in the game. Whether that results in any growth, I think the stock is telling you that in and of itself. So remember, you got this 2 weeks down sell signal. Remember this? 2 weeks down, 2 weeks up to new highs. That's a sell signal. It was confirmed by the gap down after earnings, and it's continuing to be confirmed by this really weak move. And my guess is you are going to head for these lows. I don't know if you rally up into the 200 level, right around the 200-day moving average, or maybe back up to, you know, this 194, the mid-90s, or you fill this gap. But I would watch how these rallies occur. Today you tried to move higher, not getting a lot of play here because you reverse and volume is up. So you're running into some selling here, and I think it's just a matter of time before this thing heads lower. Apple's the other one I've been focusing on, and of course it has been coming down. One thing I should also know is I don't really carry short positions overnight. I'll try and, if I make some money, I'll cover, take some profits, maybe go in light overnight, for me at least, and then come back the next day and try to put them out again. Because it is very choppy, but you can see Apple, once it broke down through the 50-day, you did the same thing Amazon did, roughly, except you went 2 down, 1 up, so that's a sell signal. Okay, so now you know you're operating on a sell signal. We've been talking about this for the last several weeks, and so this is still continuing to play out. Same thing happened with Apple, broke on earnings, and you've been 1, 2, 3 bounces off the 50-day moving average, and poof, you're down through it. Notice you rally up here, you get resistance at the 65-day exponential, which is what I would use as my upside resistance now on ultimate upside. I don't think you're going to get back up to the 50-day unless you get some kind of hairy rally in the market to the upside. If there's some announcement from the Fed that they're going to come in and buy mortgage-backed securities, maybe that sparks a quick rally. But I'm beginning to think myself, and of course Dr. K and I will argue about this frequently, I think QE is running its course, and eventually QE becomes the bid to hit, the last bid to hit, as the banks around the globe come in and give it their final shot, and it seems like that's what they're headed for in Europe. You see some of these numbers coming out of there. Merkel says that there's no bazooka coming out of the European Central Bank. The problems in Europe make the problems in the U.S. in 2008 pale in comparison. This morning I saw something where it said that the U.S. issues in 2008 were about $3 trillion. If you take Europe's issues in total, it's about $30 trillion. So there's a lot of money that they think that they're going to have to print if they're going to get over this. But I think that creates its own disastrous results. And stocks may not like that right away. So I think a massive devaluation of the euro, which you've been seeing, or the collapse of the euro, and a continued devaluation of the dollar if the Fed steps in and starts doing the same thing, at some point that may just wear on stocks to the point where you do see a break. So we'll see. But so far it's being confirmed as I see it in the major leading stocks breaking down, and of course the breakdown in stocks all over the place, and it's just getting uglier by the day. And so I'm not so sanguine about the market, but I'm sure that when we do catch a new leg down, remember, the key here, in my mind, is not whether you're catching even this move in the market here, but whether we're looking at, let's look at a weekly chart of the NASDAQ. And it's really whether we're looking at a new leg down that carries you not just down as far as you have, but down to these lows. And my guess is the model will catch that, and if you come in, there will be plenty of time to make a lot of money. In the meantime, though, I do think you're seeing the harbingers of weakness in the market starting to spread. Whether the QE doctors can cure that is another story altogether. But it is strange times.
It's the question whether how fast they're going to print the money. I mean, we've had examples of Zimbabwe, Yugoslavia, Argentina.
Right.
We have lots of history littered with examples of central banks that decide, okay, we're going to have to print a lot of money here. And so what it does is it devalues the currency at an accelerated pace, and meanwhile hard assets go up because your currency is being devalued. And so you got the euro, the pound, and the dollar. All the central banks are in printing mode, and the question is how fast they're going to print. If they print, I think that the ECB is probably on the more conservative side because they all know what happened in 1920s Germany, and they also know that history is littered with examples of printing too fast. It creates hyperinflation. Yeah, the market, it would prop the markets. It would prop all hard assets, but that would create enormous instability in the long run. So probably, right. Based on what they're thinking, they're thinking a tempered version of QE going forward, which again, that if they don't do enough, then QE does become the bid to hit, and I think the markets will start to accelerate their slide. And that we're seeing the TED spread increase. That also doesn't bode well for the markets. We only recently, really it's only been the last few days that the market has gone onto a concerted drop. So that, of course, the model is always looking for increased selling pressure. It's at a point in the last 3 days with that gap down that began this week where the edge just is not there because you have a very oversold condition with a lot of leading stocks that are at logical bounce points, like that we wrote in our report. Some of them are right at their 200-day. Some of them clearly had some stability where they closed in the top half of their range. So that kind of action definitely doesn't give you an edge necessarily on the short side at that juncture. And so the model is basically looking for a weak bounce into the into the holidays here as a possibility to get an edge on the short side. But we'll have to wait and see.
I think though on the short side, if you're looking at, I noticed what you're talking about when you logical areas to rally. So the Apple did stage a logical bounce off the 200-day. But as a short seller, what I'm watching here is how strong is this rally. And all it does is come in to fill the gap. So now I can come back and short Apple using the high of today as a stop at 375.84. That's a close stop, like 2%. And what I'm looking for here is I think Apple may be poised to break the 200-day very soon. And if I'm short Apple here, I'm looking for that to happen in the next 2 to 3 days maybe. And if I am shorted and I don't get stopped out, I may use a time stop. In other words, if I'm expecting some movement in a stock within a day or 2 or 3, and it doesn't happen, then it's a very simple matter to just back away. Jesse Livermore used to use time stops in terms of he had an expectation of what something was going to do and how soon based on the thrust of whatever he was seeing in the technical action, and he would then take a position, and if it didn't do what he thought it was going to do, he would back away within that certain time limit. So I kind of got sidetracked there, so I apologize for that. But CRM is another one I'm keeping an eye on. I do think that this is one of these. Let's see. It's kind of a head and shoulders. This is what I call the slow death kind of head and shoulders formation. It's not. You got a bunch of left shoulders. You got finally the breakdown, and now you got a couple of right shoulders. Cisco Systems was one. I think Nortel. There's a couple other stocks. I'm trying to remember back in 2000 to 2001 did this sort of maneuver where they went sideways after breaking down. They got below another this base here. So you might consider this also a late stage base failure. So it rallies up in the 200-day. Remember we talked about this one, I think, a week or two ago. So keep an eye on this thing because it was pushing up into the 200-day moving average. Interestingly, though, you notice how you get some strong volume, and it looks like it's okay. But notice the retest on the high. You notice how the volume kind of peters out. So it's like the buying interest disappears, and then the thing got hit, I think, the day before earnings, and then gapped down. And once you see that gap down, remember, this reminds us of Netflix. On the gap down here, you just go short that thing. So on CRM, if you saw that gap down, you could have probably just gone short there. I think we were sitting in the middle of a workshop at that time, which is typical. Otherwise, I would have been all over this thing. I did short it, but I've covered and took my profits on this break because you've undercut these lows right here, and it looks like you're set to maybe try and bounce. Now, here's a trick. Is this thing going to bounce somewhere into the 120, 115, 120 level? So this high, or is it going to go for this high, or is it or is 110? Since you already did, I believe. Let's see. Did you undercut here? Here's a low of 109.28 over here. Here's a low of 109.22. So you did undercut. So maybe this undercut is a double undercut, a double secret double undercut, and it's going to try and rally. But maybe the 110 area is resistance now. But I think if I'm trying to short this here and any rally up towards 110, then my stop is going to be the high of yesterday, which is 112.61, because then it might carry a little higher. Now, I'd love to see this thing rally up to 120. I'd probably be all over it there, but it may not do that. So we'll just see. It's going to be more of a function of what goes on with this market. But that's another one of my short sale targets. So I got Apple, Amazon, and Salesforce.com, and these are breakdown patterns. This is a major breakdown. Huge volume selling here and here. You had a little clue of it here, but look at on this weekly chart, you got some major selling in here. And I think what this tells you is that this stock is going lower. My initial price target would be probably the low of this pattern here at 97.92 if you're trying to short it up here. So that's probably your downside target. In the short term. Longer term, it could go down a lot more possibly. But we'll see what happens. CRM is a company that has had 100 P or higher the whole way up. And I know that's the #1 complaint against the stock, but we'll let the technical action speak for it, not necessarily the PE. But if you do get a PE contraction that's very common in a lot of leaders, that is always a harbinger of further downside. And I think if that happens with CRM, the thing's toast. And remember, Apple, we've constantly been complaining and, well, I don't know about whining, but we haven't really been too pleased with the fact that, well, at least if you're trying to be bullish on Apple, and the fact that Apple's PE, the forward PE, has been 12 to 13 the whole time it was in here, and the whole time that news was just incredible. And that forward PE just tells you that the market is not valuing the firm's forward earnings stream very highly, and that's also always a harbinger of trouble. So PEs are usually indications of a market's demand for an earnings stream, particular company's earnings stream, and so when that starts to wane and contract, that's a problem. And that's why during a bear market, high PE stocks will get decimated on that basis alone. Do you think that gold has finished the forced selling? Here's the way I'm looking at it. You know, and I'll tell you in my personal accounts where I'm trading it more aggressively, the breach of the 20-day, I just was gone right there on that day. That was it. Not going to mess around. And now it's gone through the 50-day. The only thing is here, you have not violated the 50-day moving average yet because you have not gone below the first, the intraday low, which here is 162.07. So that's your first close below the 50-day moving average, right? And you have not moved below the intraday low of that day, which is right here, 162.07. So technically, no violation of the 50-day moving average. You're right on top of this little consolidation area, and the pocket pivot on this day right here, I think it was October 25th. And so it's holding that. And remember, gold is volatile, but for my money, the way I operate in my account, my personal account, Dr. K and I both still have positions in the AGQ and the DGP in the money that we run, our money that we run together. Because we're just going with very strict and simple rules. We have an initial position on the basis of this pocket pivot, and we haven't really added to it. So, it's just kind of sitting there. Now it's not making any money for us, but it doesn't mean that we're not in the right spot with that initial position longer term, and it will try and come out. On the long side, this is probably the only thing to look at. But notice how today you are getting some support in the GLD off the lows. And it is on top of this consolidation. So my view is that low of 3 days ago, when it broke the 50, that should hold. And if it doesn't hold, then maybe we've got a sell signal, and Dr. K and I will talk about that when that happens. But, that's where we're at with gold, and we're just staying disciplined with our trade there. Not a big trade, not a lot of risks that we're taking, but we're just being disciplined in terms of handling the trade because gold could drift below the 50-day. You notice how it got above here, came down below, found support on top of this, and bounced higher. So maybe this is a retest. You're undercutting the low on that pullback, which was on November 1st, and that's going to set up a bounce back up through the 50-day moving average. So, if you're playing gold for the trending move here, hopefully it's coming out of here. And I think if the euro collapses, you'll see a move higher in gold. And if they keep printing, QE continues, you're going to see a move higher in the precious metals as well. So I think you kind of have a little bit of safety valve. The only downside is when they have to raise liquidity, that's going to go as quickly as anything else. The question becomes then whether there's a balance between the need to raise liquidity and the need to have funds in something like gold as a hedge. So, there's a little bit of balance there. So I just watch how this plays out. It's like that simple. You don't really have to worry about it. I guess, that's really where I'm at. I got 3 short sale targets I'm looking at. We got the gold position we're working. We're waiting for a sell signal in the market direction model. And outside of that, I'm not really willing to stick my neck out too far. Right now I'm only operating with one of my trading accounts, and the rest are sitting dormant waiting to see what happens. Somebody's asking, what do we think about a secondary Netflix? Not much. Do I need to? I think they're just dumping more stock out there and adding more supply to a situation where you have had less demand. So I don't think it's a good thing. Well, I think Whitney Tilson is right because it's a basic issue of supply-demand. He was complaining yesterday about it, but they're going to do a secondary offering now. There's no demand for the stock. Smart companies do secondary offerings when their stock is in an uptrend, like FIO, Fusion.io. But of course, this did not get priced very well, and the stock got hammered. It's very volatile, though. So a lot of this action tells you that you really need to see this thing set up and base at some point and get tight, and maybe we'll see that eventually. But right now, this is definitely off the table in terms of a long idea, as is every other long idea out there currently. Oh, Dr. K, I'm going to let you answer this question as I take a bathroom break. In your O'Neill Disciple book, you mention your desire to find the, quote, zone. Can you briefly describe what indicates to you that you have found it? Is there always a zone to be found, no matter what the market conditions are? Or does the current market chop make finding the zone very difficult? I don't know if he's referring to the zone, you know, when we're in the zone trading-wise, or the window of opportunity. So
Exactly.
I'll be back in a minute here.
Well, I'll answer both of those. You want to find the zone in both regards. In terms of finding the zone, or I call it the sweet spot in the market, no one knows how long a trend is going to last or how powerful it's going to be. The best you can do is look at the market day to day. The market will give you enough information so you can act on it. You can position size accordingly. You can expose your portfolio to a degree on the long or the short side on the basis of what information you're being given by the markets on a day-to-day basis. And as far as I will say, in terms of this, if you mean by zone, window of opportunity, we go back any number of years. Let's take 2005. There was only a window of opportunity really toward the end of that year. 2006, the window was open from September, October, and November, those 3 months. It was, experience told me that that it was a very clear window of opportunity on the basis that my personal account went from 0% invested to 200% invested, or maxed it out as much as I could on margin in a matter of about 3 or 4 days in September of 2006. That's the first time that had happened since 2003. That would be March into April 2003, when clearly everything was rounding out and starting to break out and pocket pivot and so forth. So when that kind of action occurs, the window became very clear. This is the time to get in. I don't know how long this trend is going to last, but in the case of 2006, it was a very powerful trend. I was able to more than double my account in 3 months by getting in on pocket pivots. I'd come up with a pocket pivot concept in 2005. Late 2005. So that made the difference for my portfolio in late 2005 and in 2006. Now, the zone, or what I prefer to call window,
I'm back, by the way,
is very rare. Very rare in terms of, perhaps that window, especially this decade, is only open maybe 3 months, 4 months most out of every year. And when it does open, experience has taught me that it's very clear, go full margin. Now, that does beg the question, why not just take the best situations, the best setups? And I am working on a strategy called the open window strategy, where it really minimizes the amount of exposure you're going to have to the market, because the window doesn't go wide open more than maybe once a year. And in looking at my own trading, had I only traded those few months out of every year where the window was wide open, I would have kept more of my profits. So it's something that's in theory right now, but I'm looking into it in more detail to see how I could apply it to my own trading, and then I'll end up sharing it with everybody else. I think it's very hard to execute in practice, because most of the time the market has a window that's sort of open, and that's usually temptation enough, especially for traders, to want to be in on the action. And so I need to reconcile that with my own trading personality as well, to be able to just say, okay, the window's not clearly open, I'm not going to do anything. And then you see the market go up for, let's say it goes up for 3 weeks in a trend, a very nice trend, and you feel like you've been left behind. But nevertheless, to have the discipline to say, well, the window wasn't open, so it doesn't matter. I've missed this 3-week rally, but I'll catch the next one when the window has been open in like late 2006. That was a 3-month uptrend, very powerful. Or another example would be September 1st of 2010. There were a lot of good setups, and that was a very nice, powerful uptrend that went about, about 2.5 months or something. So these periods become very clear, and so that's that definition of zone. The other zone of being in the zone personally is just all about your mindset, right diet, right exercise, and we talk about that to some extent in our book, and I think we have some stuff on it in the FAQs.
Yeah, but I think they're referring more to the idea of the window of opportunity. So, I think windows of opportunity don't necessarily occur in just the indexes. I think they occur in individual stocks, and so you have to be attuned to that. And I think part of that, again, is having the patience to wait for the right setup, to come in at the right time, with the right trade. And so even in this environment, like I told you, October was a good month for me on the short side with Green Mountain, even though the market was going up. So you might argue on the short side, if you're just basing it on the index alone, that wasn't a window of opportunity. But I think if you were awake, you noted that you had a situation where you could treat the market less as a stock market and more as a market of stocks. So that's the number one basis, for how I'm operating. The number one principle for the way I would operate here. And that is all based on understanding that the way this market is, chop and slop, there really isn't a window of opportunity in terms of a general index trend, but I do definitely think there's a window of opportunity in terms of dealing with individual names, but you have to be patient and wait for that specific name in that specific setup. So it takes some time sometimes, and you have to be patient. I think all around that's really the message of waiting for the window of opportunity, the zone
Yeah,
of opportunity. Yeah.
the
But it's
window.
it's a lot more subtle. It's a lot more subtle than just, oh, we're in a bull market so you can't go long, or you're in a choppy market and you can't do anything. I think in a lot of cases it depends on what you're seeing in terms of your approach. And in this market, the approach is to come after things as not uh, a stock market, but a market of stocks. Again, just
Yeah,
focusing on individual.
I would argue that that the way I've always traded actually is to treat the market as a market of stocks, and I always let the stocks, as I'm fond of saying, I let the stocks tell me what I need to do. So, in other words, a good example is March of 1996. My model was on neutral, it was in cash, yet I saw a lot of great names starting to break out. And by I think it was the third or fourth day of this action, I just started buying. I didn't care that the model was in cash. Back then, I had a rule that said, well, you should sit out and wait till you got the green light. But there was so a propensity of overwhelming evidence of good leading names starting to break out, and the right thing to do was exactly to buy and buy every single one. So that's how I generally, I think that's the best way to treat the market. When you're dealing with stocks, treat them as a market of stocks, because certainly GMCR, there's some names that have been great opportunities on the short and the long side. I mean, gold and silver earlier this year were huge opportunities. MCP was a great trade earlier this year.
Yes.
There are these the window with MCP. I bought that a number of times just because I was very very confident that the wins were at my sales. So that's I think it's good pays to keep that in mind. And as far as the market direction, that's all about the market direction model. That's about the ETFs. The model, I love the track record. It's done well around the edges for my own account. I'd like to be able to utilize it in a much fuller way because of its track record, and utilize it in terms of 3x ETFs, getting more and more exposed, because the model has done, even in August into September, it made some really good calls, and then October the market's very choppy, so it had some false calls. But the false signals are protected by the failsafe. Even in a volatile environment, I think the losses on the Nasdaq were still contained to within about 2.5%, whereas most of the time the failsafe kicks into less than 2%. But that's forgivable given the volatility we've been experiencing.
Right. I should mention I'm going to be taping this afternoon for a show that on Fox Business News. It's going to be aired at 6. I think it's 6 p.m. Oh, Eastern or Pacific, I forget. But it'll be David Asman and I think Bulls and Bears, or I forget. What's that show he does late in the evening? Does anybody remember? Let's see. I'm checking the emails here. Power and Money. It'll be taping at 2:40 Pacific time, so I have to be at the studios there, and they will air the segment at 9 p.m. Eastern, 6 p.m. Pacific time. And they're basically expecting me to be bearish. I'm not bullish on the market, that's for sure. We're in cash, but they're saying buy retail. buy retail on the pullback? I guess you could, but you know, it depends on what you're looking at. I don't see anything acting well. Lululemon is acting poorly. Deckers, you know, these are all getting whacked off their peaks. You know, the RTH is what some of the bigger ones. Dr. K, chime in here as far as your thoughts go. Walmart on a pullback, and that's more defensive. Target. And I don't know. These stocks look pretty weak to me. I'm not a buyer. What about you, Dr. K? What do you think of retail? Let's answer Fox's question ahead of time. So I guess you're going to have somebody on who's very bullish on retail, whereas I'm bearish based on the technical action because we don't come from the university, or we didn't graduate from the university of I'm smarter than the market.
I mean, this is a tough environment for long stocks, certainly, because of the choppiness and retail. They could argue that there are some retail groups that are showing a lot of strength. I mean, Target,
yeah.
the major discount chain retailers, they are showing strength. In fact, I think they're ranked 10th out of, they're ranked 10th. So, but on that, it doesn't matter. You know, when the market comes off, it takes most everything with it. So, I would be loath to be in any kind of retailer right now. I would be looking for a setup where a stock clearly is bucking the trend and then issue some sort of pocket pivot, because I know the market is where it is right now, but if you don't have to go back very far. You can look at August, September, October, where the market just sold off very hard for, say, 4 days, and then had a fierce bounce to the upside. And it keeps doing that, and that makes this environment very treacherous, as opposed to any kind of coherent type of pattern that we're normally used to seeing. And also after the May 2010 flash crash, the model intentionally stayed in cash longer than it normally would have. That turned out to be a good decision, because as you can see, after May 2010, the market was very sloppy and noisy. It took three signals prior to the September 1st buy signal, and 2 of those 3 signals were minorly profitable, and 1 of them was minor loss. That was the right course of action. Under normal conditions, had it not had restraint after the May flash crash, it probably would have had 3 false signals and 2 true signals versus 2 true signals and 1 false. Right now, it's kind of in that same mode where it's just not seeing an edge. It's seeing a lot of volatility and slop. But that said, it's a lot closer to going to a sell signal, and it's looking for either a weak bounce or concerted, renewed selling pressure.
Okay, so what does that have to do with the retail stocks?
Well, I was just rounding out what we were talking about earlier today. Retailer,
okay.
Not interested in retail.
I'm just curious because I got to go on Fox, and as long as we're on,
I would just say, there's not a whole lot to play on the long side until the market has, shows some sort of stability, and also I don't see any retailer stock that is really bucking the trend that's looking amazing in this environment.
Right, exactly. So, my view is the technicals on most of these don't look good anyway, so I'm not a buyer on that basis alone, and I don't need to get into some long. I mean, here's the question. Focus in this, Gil will be on with Thomas Belasis, CEO of John Thomas Financial. Sounds like a retail broker. Focus. Stocks sink in 3 days before huge shopping day. Worried or not? Well, we're not worried because we're not long stocks. We've been short stocks. And in cash, so really not worried there. But I don't think you buy anything in this environment. When
if you have to buy something, I would say PNRA, Panera Bread. That's probably the best looking one out there. Had a gap up,
that's stabilized, okay.
And good fundamentals, all that. So that would, if I had to buy any retail stock, it would be PNRA on a pocket pivot. I mean, in fact, it did have a pocket pivot yesterday. So that's the only one I would touch. And maybe there's another one I haven't seen. I've run the screens here. I'm not really looking avidly for stocks on the long side. We have our leaders list, and nothing there is looking all that good. So
somebody's asking about James Fair. I've already talked about it. I mean, it's way down there, so you have a bounce off 40. If you're short from up here and you're still short, maybe it continues lower, but I'm not going to try and short it here. Cena has come all the way down. It's undercutting this low, so it's in a position to rally. So if you're short that, I'd just be watching that. Let's see some other names in here. People are asking about Win. And Win heading for this low. So, you know, it's come down, nice gap down. Probably I would watch for an undercut of this low and then trying to come bounce out of there. So, you know, it looks to me like with the market selling off today, it's just continually drifting down. So you have no bid coming into this market, despite the fact that you're running lighter volume today. Running about 13% lighter on the Nasdaq right now and 8% lighter on the New York Stock Exchange at 10:41 Pacific time. It seems to me like you're not really getting any buying. Whether we see anything come into the market at the end of the day, we'll see. But who wants to be long anything in this environment? Who knows what's happening with Europe? I still think there's a lot of issues there, and to some extent, maybe the action in gold has been telling you that in the short term, the QE thing isn't there for gold just yet. Maybe it's coming, but we'll find out. In the meantime, the market is clearly in a downtrend, and there's no reason to be buying stocks. So all we're waiting for as far as going with index ETFs on the short side is Dr. K's model to go to a sell signal, which it hasn't yet. But in the meantime, we are messing around with some of these stocks, and they do continue lower. And, you know, I think Amazon here is definitely a short. I think it's heading for this low. So it's just a matter of what can you sit with, where do you get in without getting stopped out, and I think you can work that. I think Apple's probably going lower, but I think like Cisco in 2001, it may take a long time to let go. I think Amazon may be one that they let go of faster. And of course, Amazon is well below its 200-day moving average, so on a relative basis, it is weaker than Apple right now, which is holding the 200-day line. But you know, Apple held its 50-day moving average for a long time, and more recently now it's testing its 200-day again. Maybe it eventually does go right through that. Who knows? But I do think it's a weak stock, and it is on my target short list. But I like Amazon here. The CRM, I think 110 again becomes resistance short term. If it gets through that, then you're looking, you know, and if you get short in here, definitely you want to stop yourself out quickly and be ready to come back in if the rally continues. It's probably going to depend on what the general market does from here. And right now things aren't looking so hot, but as we know, in a QE environment, that can change pretty quickly. So here's a question here. Is it a useful strategy to follow stocks heavily bought by institutions per IBD during a correction as new leaders when uptrend begins, or is that activity primarily noise? Well, you want to look for new leaders. That's basically all. I don't know about whether they're ones that institutions are in heavily at the time. When you want to see sponsorship, so I don't know. I wouldn't pay so much attention to that. Borders is done. ANF crushed. BBY horrible. I love that. That's awesome. Thank you. I'm gonna put that out today on Fox. Borders, Abercrombie. Didn't Ann Taylor get hit?
Yeah, Ann's below the 200. The majority of retailers don't look good. It's only a scant few that are holding up.
GNC, it's bucking the trend. Well, vitamins, I guess, not necessarily retail, but there's areas of retail, and so I don't really think. My point on Fox would be that I don't really think the market weakness is necessarily a sign of what you're looking at in terms of the Christmas shopping season. I think it's more in terms of what you're seeing out of Europe, in terms of what you're seeing for the economy at large, and I really think that's the key here. So that'll probably be my argument. XLF, 1044. We're going to wrap up here pretty quick. I mean, XLF is telling financials are weak, and I think yesterday the Fed said they're going to start stress testing, I forget, 6 or 7 of the largest banks. Bank of America, Citigroup, Wells Fargo, JP Morgan, Goldman Sachs, and I think the other one is Morgan Stanley. So they're going to stress test these for if there's problems in Europe. My guess is they're going to have problems in Europe before they ever are able to finish a stress test as far as what's going to happen to these banks if something goes down in Europe. So I think that's all kind of baloney, but I do think with the stress tests out there now and waiting for the results, that's going to put some pressure on the financials, and you're seeing it. I also think the weakness in financials is symptomatic of just what's going on in the world, and that is the collapse of various monetary systems like the EMU and the danger it poses to the global financial system, including banks in the United States. So yeah, that's what's going on. I'm joking with my trader, Bill Griffith, earlier that, if we lose money in the market, if we make money in the market, it's not going to matter because if it's in dollars, it's going to become worthless pretty soon. So I'm beginning to become something of a curmudgeon and cynic, but, it's hard to see any other way out of this. They're either going to print, we're going to have massive hyperinflation, or something else is going to happen, but we'll see. We'll see what happens. Biogen was a stock we talked about yesterday. Someone's asking about that. Had a pocket pivot, but the one thing about this pocket pivot, there's one caveat, and that is the stock's kind of in a downtrend, so it's not necessarily going to work right away. It is this is actually not the right chart to be using. Let's see, that's my NASDAQ chart. Let's go over here. You had a nice volume signature. You're pulling back in here, so maybe if it sets up, that would be okay. That's one to keep an eye on. But there's not really too much going on. The other pocket pivot we looked at was yesterday. This one, or 2 days ago, I think on Monday, and you had a nice pocket pivot. It's holding the 10-day, but in this environment, it's a smaller stock, so it can get knocked around pretty quick if things get ugly. So we saw what happened with FIO, Fusion IO. Ulta, Salons, yeah, that's one. It's trying to break out, but it's a little bit slow. Under Armour's another one, but that's broken out and failed. Abercrombie and Fitch getting hammered, Ann Taylor getting hammered, Best Bed Bath & Beyond getting hammered. Well, not getting hammered, but it's coming off. So I don't really think let's forget. I don't think you want to be.
Yeah, you got to be careful in this market. I mean, as we always advise, position size according to your environment. This is a higher risk environment, so any actionable reports you put out on the long or the short side, people should be aware that this is a gap up, gap down environment that can cause some of these setups to have a higher failure rate.
Yeah. Somebody's asking, is there potential for the European central banks to start selling gold in order to raise money? That question was asked of me last Friday. I was actually on Fox on Stuart Martin Company last Friday morning from Las Vegas. They actually said I was in LA, but I didn't really look at the backdrop there, Dr. K. Did you? Was that a Las Vegas backdrop on that video, or was that a LA backdrop? In any case, I don't think it matters where I'm sitting at the time. But they asked me about Italy, and Italy has about $160 billion worth of gold. That's only 5.8% of their total debt. So I don't think, in most cases, I don't, and Italy has the fourth largest gold reserves in the world. So in most cases, I don't really think that is a factor. What they should do, as I said on TV last Friday, is that I think they should try and, well, if they were going to use it, what they do use is collateralize it as collateral for issuing more debt. Maybe that would give that debt a little more, credibility, rather, and that's what I think they might do. So, CMG as a short. A couple more questions here because I do have a call coming in from Fox at 11 o'clock in 15 minutes. I don't know. It's below the 50-day. I'd like to see rallies up in here to short into. So you're kind of undercutting this low here. You're near the 200-day, so I don't think you have a lot of downside juice. It might try and bounce, so I'd just watch for that. Costco. Let's see. Retail. What's this say? Retail downshift into bargain price business. Everyone will pass the stress test and the market will like it, maybe. Thoughts on TLT? Well, that's just bonds. And, there's a fear bid going into bonds. There's also a fear bid going into the dollar, too, I believe, and you're seeing it. So, there's trouble in Euroland, and I think that's really the issue here for the market in general. But I certainly wouldn't be buying retail stocks. Anyways, I think that's about all we got. Q-Core, iSurge, we're going to go through those real quick. Whoops, not Q-Core. It's holding up, so if you're long, you could use, well, it's already violated the 10-day, but it doesn't tend to follow it. You might use, the 34.80 level as your stop, but I don't know. I can't tell you it's going to go higher. In this market, I don't want to own stocks. End of story. So
you can use the
if
low
you're
of the
okay,
gap
you're up on it.
Use the low of the gap up day if you really, have to.
Yeah, you could use this low as your stop, and that is 40.18. It's a little bit tighter there. No, I'm sorry. What am I saying on this day? 37.60. That's a ways down there, Dutch. I don't know. That makes me nervous.
Yeah, I know.
I don't want to own any stocks. But if you were going to hold it, I guess that's what you could do.
you could use that as your stop, but
Yeah.
play lightly in this environment.
We got iSurge trying to, I guess it's holding its gap roughly, but that's about it. So you could use that as your stop, and maybe the 50-day at 404. So, but nothing terribly exciting here. All right, the last thing we're going to answer here before we sign off is Dr. K. If the model goes to a sell in subsequent days, can you comment on the potential for TVIX within that context?
Well, as you all know, TVIX is the most volatile of the ETFs, so we would not be recommending TVIX unless we really see an open window of opportunity on that one. And if we do recommend it in a future signal switch, we will certainly advise accordingly on how we would suggest it be played, because the gains are massive, but the drawdowns are also quite huge on TVIX. It also sometimes, and this is a good question we got earlier through email, you'll notice that TVIX, even though the market's gone straight down in the last 4 days, 5 days, TVIX is not going straight up. TVIX is not going straight up because what this is telegraphing to me is that you are getting effects of QE, even though the market's going lower. When it gaps down, there is QE being pumped into the system, which stabilizes the market, and that puts a lid on TVIX, which is a measure of volatility in the market. In fact, it's twice the volatility of the VIX indicator. So the fact that TVIX really isn't very profitable when it should be is, I think that speaks for QE having an effect, which then begs the question, if QE wasn't there, maybe the market would have had a much rougher slide. And,
crashed.
That might be right now at trading at 2,200, not at 2,475.
Right.
So the QE effect is there. I mean, we saw it in October. We're seeing it now in subtle ways. So it's just a question of if the bad news starts to, if we get like a rest between now and the next piece of bad news, QE could certainly push the market higher in that low volume, lackluster way. And that's not a very nice environment to be trading in.
No. So anyway, so that's where we are. So I think you get a clearer picture where things are going by Monday. But I want to assume that you're going to have quiet holiday trade, either for the rest of, obviously today you haven't, and only in the sense that you have a hard sell-off on lighter volume, and maybe you get something like that again on Friday. So other than that, that's it, everybody. Have a great Thanksgiving, and we'll catch you next week.
So long, everybody.